Welcome, everyone, to Quiver Financial's Taming the 2022 Bear Market. This is our third episode because it's the end of the third quarter. And we do this each quarter as a way to communicate to our clients and anybody who's interested in becoming a client what we're seeing markets doing and what we're forecasting the moves that we could make. Our structure is very simple. We narrow things down to 5 categories because if you think about it, your net worth is controlled by 5 major asset classes. So, for instance, interest rates and real estate are tightly related. They have a big effect on your net worth. Equities, another big portion of your net worth. Commodities and currencies have an interaction together. So if we track these 5 asset categories, and if we can get those right, then we can usually get the rest of the market right. So every quarter, we like to communicate what we're seeing in commodities, interest rates, real estate, equities, and currencies. Did I say currencies? And the currencies, holy cow, is the big one. So, gentlemen, I'm Colby McFadden, joined by my esteemed colleagues, Justin Doubleterry and Patrick Lesshead. Oh, wait, I got that wrong. Sorry. Justin Singletary and Patrick Moorhead. Gentlemen, what the heck is going on in the stock market? That's what everybody wants to know, and we're going to get into that. But holy cow, what a widowmaker this market has become. I mean, there are a lot of widows and a lot of children that are going to get their inheritance a lot earlier with this stock market volatility going on. So we're going to talk about that. Is the stock market going to crash?
Yeah, we're going to get into that. So, we're going to get into the stock market. Is it going to crash? We'll also talk about real estate. Should we stay in? Should we buy? Should we wait for a dip? Mm-hmm. Interest rates going to be a huge conversation. And what should you do during a bear market? I mean, a lot of people are going to be asking those questions for sure.
Are we in a bear market?
I think we've been saying this for a while.
Not under the new definition, we are not.
Well, okay. Now,
so
everybody's saying we are.
Well, let's get right into it. So in case you folks missed it from our last one, is the real estate market going to crash? I think this is a big question. I think we've seen a lot of interesting conversations around the real estate market recently, and so we'll definitely get into that. We do have a YouTube video on that, so important for you. For those that missed it, go to our YouTube page and get a chance to check out what we talked about regarding real estate. And I know there's going to be a lot more updates that we'll have in this video here.
Yeah, I'm going to add in there, I do really want to update this because we were pretty tame in this particular video, and since then there's been much more data that's come out where some of my viewpoints have shifted a little bit, but definitely worth updating. But it's a great video.
And this next one, is the dollar doomed?
Woo!
We did do a video on this, so for those, again, that missed it, go check it out, YouTube page, and I know we're going to get into this conversation for sure in our here shortly. So
kind of counterintuitive considering the dollar just keeps going higher.
Oh, it's so strong. Wait till you see the charts in a few slides. The dollar is amazing right now.
And then, yes, catch the next wave. How long-short strategies can help in bear markets. We're going to talk a little bit about that as well, but we did do a video recently on that, and we had a good friend of ours, Jordan Kimmel, come on that one, and he talked very heavily on the importance of long-short strategies and how they can be beneficial in somebody's portfolio.
Yeah.
So when you get a chance, check out that one if you have any questions or, wondering about what a long-short strategy is.
And it's something, too, that we're going to be expanding on a lot more going forward because this is going to become greater and greater emphasis as the markets kind of progress.
Yeah, a lot of people have a misnomer of what long-short is, so we cover that, kind of give some clarity of what the different long-short strategies are out there, and more importantly, when and where they can be utilized, because a lot of things, certain markets they're better for than others, and it's part of that knowing your alternatives when you're in a bear market.
Yep.
And last but not least, in case you missed it, red zone investors. Come on, guys. I know if you're at age 55 to 60 or 65, 70, looking for that retirement, soon to be retired, or maybe you're already retired and you're going to need that money in a matter of years. That's a really good video to check out. I highly recommend it. All of them are really good. They're short term or short duration. But yeah, we check out that one when you get a chance. But we'll talk a little bit more about that in this one as well.
Yeah, I mean, listen, if you're a baby boomer and your attitude right now is, in 2008, I lost half my 401k portfolio value, but big deal, it came back, right? Okay, fine. Now, do you have 10 more years to wait around? Like in '08, a baby boomer today in '08 could wait 10 years. They weren't going to retire yet, but baby boomers today are retiring every day. So you don't have the 10 years in front of you to recover from losing half your portfolio. So don't be thinking '08 style in 2022.
Right.
Right. So
It's 4 down territory.
yeah, it's 4 down territory.
Does that 60-40 model always work?
No.
Is that going to work for the
It hasn't worked for
stuff?
years.
But yes. So all right, guys. Well, let's keep rolling here. So coming soon, or I'm sorry, in case you missed it. So yeah, go to our YouTube channel. You can find it on our website, www.quiverfinancial.com. You can locate it on our blog page. All of our YouTube videos are there, as well as going to YouTube and typing in Quiver Financial. Please subscribe. Get a chance if you like the videos.
We do have podcasts too, so if you'd rather listen than watch videos, you can find us on all the majors for the podcast.
Yeah, we need your guys' help because we're putting a lot of good information out there, and the more people like it and subscribe to it, the better it helps us. It's this world of technology that we're all having to live within. It's like you're living in one big high school.
Yeah.
Yeah, so if you've liked the
kids.
information that you've been getting, you subscribing shares it with your fellow colleagues out there, and so.
Yeah. So we've made it easy by hitting it from our homepage or our blog page.
And just some things that are coming soon. For those of you that follow us, we're going to be getting text notifications of new videos, blog posts, events for those of you that are local. So always keep an eye on that stuff. Also, again, like I mentioned before, help us subscribe to our YouTube page. Go to Quiver Financial. You can find us on YouTube, and like Patrick said, other streaming services, Spotify, you name it. 401k optimization.
This is cool.
This is
fun.
really cool. So this is important for those of you that are still working, talking about that red zone. If you're working at a fairly sizable firm like an Obvi, an Abbott Labs, those Edward Life Sciences, we have a few clients that work there, and we've actually been able to help them with their portfolios while they're still working, and actually some of them are going to be retiring soon. So it's been a really good opportunity for us to get access to their 401k and give them guidance on what to do.
Yeah, it's really cool. If you're a baby boomer in the red zone and you want to optimize your portfolio, if you know you're going to need your money in the next 5 years, or you're going to retire some change, and you really want to optimize that 401k, we now have a technology platform that allows us to help give you guidance within the 401k, and it's seamless. It's an incredible thing for people that are in that late stage of working and still needing to grow their portfolio and preserve it.
Yep.
So, and we're starting with just a handful of companies because we want to make sure we do it right.
And even if you're not in that late stage, Warren Buffett said it best, rule number 1, never lose money. So, even if you're in the younger years and you have the time to come back, your portfolio benefits so much more if you just don't lose the money during a down period.
Yeah,
so
I've been wanting that for a long, long time, so I'm very excited for that.
And this one here, catch the next wave, or investment wave. So the last bull market in oil and how investors can play it. I know you've been talking a little bit about this recently, Colby, with us.
Well, when I came in the business, if you didn't have oil and gas stocks in a portfolio, it was un-American. It was like the quickest way to get fired as a money manager back then was not to have oil and gas stocks in your portfolio. It's kind of like not having technology in your portfolio the last 10 years.
Right.
So, when you look at what's happening, there might be this last bull run in oil and energy. And I know a lot of people are like, yeah, but solar and wind and ESG. Well, guess what, folks? Let them do all that, because the people, in my analysis, the people that have the money are the old school guys, the Chevrons, the Exxons. So they're just going to let those things develop. So we're going to talk a lot about that and what's the attitude of the Middle East around this, and how that also ties in politically to a lot of what's going on geopolitically right now. So it's a very interesting time to be talking about energy.
Yeah, I agree. All right, so let's get right into it.
All right,
Here we go.
Enough with the commercials. Let's get right into the.
So here you go, folks. This is what's been going on year to date as of yesterday. You can see all of the percentages here. S&P down 23%, NASDAQ 32%, corporate bonds 18%, gold 10%, 10-year treasuries moving all over the place, oil, gas, commodities. It's pretty amazing.
Well, and here's the thing is, you got oil up 17%. Now in June, in our last video, I think it was up like close to 70. So it's come down quite a bit from that peak. Natural gas was it was like a double and a half at some point. So it's had a big correction. And food commodities were up about 30% back then. Yep. So, when you hear about the inflation story, you can see since June, there's been a tail off at least in the commodity prices. And then when you go into like other commodities like lumber, it's just been a straight dive down. So I know there's a lot of stuff about inflation, but by the numbers, it does appear that we may have seen peak inflation, but it doesn't mean it can't roar its way back. And it probably will, because I think all of these particular sectors are the ones that have secular growth in the future.
Yep.
But I mean, gee whiz, look at that as far as like corporate bonds down 18. The 10-year treasury moving 1.5 to 3.8. You know what that means? Like U.S. government income funds, like Franklin Government Income Fund. The stuff that, the most conservative people look for are down double digits for the year.
Yep.
So I think you're overlooking the gold. I think the fact that gold is down 10% in an inflationary environment like we've been having is unheard of. Like historically, that just doesn't happen.
We said it in our last thing. Gold has been the biggest disappointment since all of us to our parents in high school.
all the money that was supposed to go to gold went to Bitcoin.
Yeah, it's crazy. Yeah, well, gold will move when the Fed stops tightening and the dollar stops moving.
Weakening. Yeah.
So no need to be there yet because the trend's not there. So
keep this in mind, folks. These are the current numbers. This is important. This will go right into everything we're going to get into. So here we go. Investors' biggest questions going on right now.
Yep, this is what we're hearing from everybody.
All right. So stock market and real estate, cash or buy the dip?
Crash or buy the dip?
Yeah. Sorry, did I say cash? Crash.
Well, this is the thing. Everybody wants to know what's going on in the stock market and then real estate too, because it's become top of mind with the rise in interest rates. So we'll get into that because there's signs to watch for to know what to do next.
Interest rates. How much higher can they go? And what an income investor can be doing now? Yeah, I would think that this is like if I was an income person, like somebody who says, hey, how do I create income in this environment and have preservation? That's a hard answer. There's an answer to that question, but it's you got to know what the heck you're doing. Yeah, the Fed's been a little bit all over the place. They started out one way and now they've kind of changed their posturing a little bit, so that'll be fun. Currencies, here we go, the dollar again. What is going on with the dollar? What to expect in the next phase of a bear market and how to protect and profit from it. Yeah, I know. I love when the media talks about everything that we talked about a year ago. When we get into the slides of the dollar, we felt the dollar was bullish. There's been a significant change in my viewpoint in that. And it's worth understanding what that is because it makes a really big difference to what we expect coming up next in a lot of different markets. And that's why tracking 5 asset classes, people don't realize how important the dollar is to the rest of their portfolio. Everybody looks at stocks and bonds. That's like the tail, right? The stocks and bonds are the tail. If you want to know what the dog is wagging the tail, it's currencies, it's interest rates. So most people are looking at the wrong thing when they start to build their portfolio, and that's why when you get into a bear market, everybody loses money.
Well, and the Fed doesn't care about the stock market either. They're focused on those exact same things. They're focused on interest rates unemployment and currency. Like the stock market is going to be a residual effect that they don't care what happens. The bond market's way bigger than the stock and the equities.
Yeah, and I will say, and we'll get deeper into this, folks. But I will say too, you'll hear me say more and more. This is coming in my mind as I look at demographically where we are. And if you really think about it, baby boomers that are retiring quickly, they've never been wealthier. I mean, their house value is high, their 401k value, even after this recent decline and such. So I think the Fed knows that at the end of the day, 10 years ago, they were very worried about the baby boomers having enough money to retire. I think now, for the vast majority, yes, there's pockets, right, but for the masses of baby boomers, I now think the Fed realizes, okay, most of them, the wealthy ones at least, can afford to take a hit. And then you've got this huge millennial population coming through that's underhoused. There really aren't enough jobs for them, even though there's a job shortage and such, And so I think the Fed knows that they got to make room. They got to give the millennials an entry point, right? And so I think you're going to see this wealth transfer from one generation to the next via the Fed in this process, and it'll be called a recession. And it is what it is. So I'm going to joke with all the baby boomers that, yes, hey, thank God your grandchildren are not going to move in with you, but you're definitely paying their rent in one way or another. Go ahead, sorry.
All right, so this one, alternatives. What alternative investments do well in inflation and recessionary periods? I mean, I think this is a big, important one. And we also did a video on this as well. I know I alluded to it earlier, and I think this is important.
Yeah, it's huge. I mean, everybody looks at stocks and bonds, and you get into a market where all those things are falling. When we get into the first and second phase of bear markets, you'll understand why knowing your alternatives at this particular time is really, really important.
Especially during inflation and rising rates. It's going to be huge.
Yeah, no doubt.
All right, here we go.
So I think now
stock market and real estate. Here we go. Cash or buy the dip?
So this is the Marsha, right? Let's start with what people want. What's going on in the stock market? So is it crashing? Yesterday was a horrible day. In bear markets, you tend to end the week on the lows, whereas in bull markets, you end the week on the highs. So if you can throw us up maybe a chart of the S&P 500, and we'll talk about what we had said in the past. So back in June, we'll go for the next. So you'll notice up here in the corner that says June 16th. So this is from our last event, and if you remember, market's been falling since about February, March timeframe, and around June. We had said, we're probably coming into the zone. We should expect a bounce, at least a bear market rally. And so you can tell by the red lines, we expected, a bounce up to about 4,200. We did an update sometime, I think, in August, or actually when we were approaching 4,200.
Yep.
And I had mentioned that maybe that's just a little too obvious because too many people were talking about it. And if you go to the next slide, you'll see what's happened since then. So where that 3 is basically the end of June. That red line is the red line we had on the last slide. 3 to 4. And that could have marked what we call this little micro fourth wave. And one of two things is going to happen is right now it feels like the market just wants to knife through the June lows, right? And if so, that's probably a pretty massive wave down. And not necessarily, what you want to see. If that's happening now, the bear markets would probably be a little bit bigger than I originally thought. So the big question is that comes up now is, do the June lows hold? Yeah. So if you can go to the next one, what would be normal for a market? Like markets love to create maximum frustration. So right now, attitudes are after Friday. We're crashing. We're going lower. Justin, you had pointed out the options markets.
Yeah, I was going to bring that up. Yeah.
So people would expect a crash, and if the market wants to create maximum frustration, maybe it could reverse course here and make another run higher. That's a big if, right? So I just bring that to people's awareness that sometimes these corrective waves. We know we're in an impulse lower. It's just, is this corrective wave a simple one where we bounced and cratered? I mean, that did happen in 2008. Normally, I'm not so suspecting that the market's that straightforward and easy. So we are just looking right now for signs, and we'll know that answer next week, because if the market's crashing, then Monday, Tuesday, Wednesday is going to be ugly days.
Yep.
If all of a sudden the market reverses here, then maybe you get a short squeeze because so many people are short this market.
Yeah, I was going to say that the options market is definitely ripe for a short squeeze. There's so many people that are short the market right now. It's like almost to 2008 levels.
Yeah,
it's pretty intense.
Which is why we forecast because of all the different parameters. I mean, you can't make a prediction. It's a 50-50 shot in reality, and I don't think sentiment has really hit to cause that knife to go straight through down to 3,300 down pre-COVID or pandemic levels. So I'm leaning more towards the bounce just because the VIX hasn't spiked. We're shorting the market like crazy.
The VIX is still lower than it was at the June lows.
Yeah.
That's a sign.
So we just don't have, they always say the bear market's over when people are just fed up and want to, so we're not even close to.
We haven't hit that capitulation.
Yeah, we're not even close to people. It's too much complacency, way too much complacency going on in the markets right now.
Yeah.
Well, and you could see where the stock market.
And think about this too. If you look at the charts, even in this recent decline in the last couple of weeks, Apple, which is a big part of all indexes and all things, has actually had really good relative performance to everything else. So until Apple cracks, or until the generals crack, right, you're not going to get a crash. So but I would say, like, for anybody who's like wondering, is it crashing now? It's like, what's exciting about watching markets right now is we're going to get most of our answers very soon, because Friday was options expiration. It was quadruple witching, which means you're going to have an incredible amount of volume. And when you look at a daily chart, you're going to have this big print of volume, right? Most of it artificial because it's options, but nonetheless, it's guys who run certain algorithms. It's going to print a big volume print, and if that's in the middle of a downward move, those algorithms are going to interpret that as up, third wave, momentum going lower or crashing. If that big volume print ends up a couple of days later with a reversal, then a lot of those algorithms are going to interpret that as a reversal, right? And then pile on to that reversal trend for a counter trend trade.
Right.
So the neat thing is no, Monday, Tuesday, Wednesday, what the hell is the market crashing now, or is it going to give us a few weeks before it crashes? I think the end result is the market's going lower. It's
overall,
just does it go lower now, or does it go lower later?
Yeah. And the algorithms and all that stuff is, like you said, it's exciting because everything happens so much faster now. Sure, because of those algorithms and all that type of stuff. It's so hard to predict the movements because when you see it, it's already in progress. You can't make a move that quick.
That's why you got to be preparing. You can't do anything nowadays in you have to know what you're thinking and doing moves ahead. This is investing today if you're managing risk. Right, if you're trying to make sure you don't lose a lot in a bear market, it's like a chess game where you got to be thinking the next 2-3 steps ahead. Right. So let's. What's next?
Really quick before we go on, could you maybe give a little depth on with the generals, like what that means, and if if we take out the generals, what does that mean?
Yeah. I think we might have part of that. Yeah. So these are the things to keep in mind. Yeah. So the big things to keep in mind is and realize you're listening to some people that have a bias. Anytime you get advice from people, you got to understand where their bias is, and sometimes their bias isn't right. So our particular bias is that we're in a generational bear market. That's different than just a bear market. Okay, a bear market is like 2000. 2001, 2002. Yes, the rich people lost money. Technology went down, but people weren't moving back in with their parents. The recession was pretty, light, and most people don't even remember it happened at this point. Yeah. Okay, 2008 is a generational bear market where it imprints people and it made a difference. Some kids didn't go to college. Things got delayed for a lot of people in 2008. That's this, in our opinion, this is a generational bear market. So. With that in mind, that's how you viewpoints things. So, which means this is that it's probably going to last longer than expected. And there's going to be a few phases to it. And what I was watching is the first phase is commodity prices rise, inflation goes up, stocks and bonds go down. And then in the second phase, eventually what happens is everybody goes, oh, shit, we're in recession. And then everything goes down, and the only thing that goes up is the dollar. And I was hoping that we would hit the second phase maybe a little bit later this year.
Yep.
But this week and last week, when you look at the charts and how everything was selling off except for the dollar, it sure does feel like we've transitioned or are transitioning into phase 2, which means if you were worried in June, for lack of better phrasing, you should be shitting your pants today and not waiting to act. All right, you should be calling us and saying, okay, what do I do in my personal situation? Because we can't give you blanket advice at this moment because we don't know. But this is one of those times that you don't wait to get advice. You know, this is one of those times that, you know, like, hey, you're stage 4.
Yep.
You know, this is not, hey, there's a little something, we'll watch it for, 6 months and see if it develops into something. This is, hey, we're metastasized and there's a problem.
Especially if you're in the red zone.
Yeah.
And to go back to your 4 generals or whatever type of thing, it's the top 10 stocks in the S&P 500 are 28% of the market cap.
Yeah.
28%.
Yes,
So your whole first phase, when we talked about this yesterday, the first phase of, some things are making money. Those, like you said, Apple hasn't quite rolled over yet. That is part of the second phase, nothing's making money. So we're on the cusp of the transition, which is kind of one of the most dangerous, and we're knife edging potentially going through the market. So that aspect of it, of listening to us, you say we're biased, but at least we're giving you guidance of things that's potentially going to come down the pipe. We're not talking about the now, we're talking about what's going to potentially happen, things to watch out for, key features to be looking out for that inevitable rollover and transition to phase 2 where everybody's going to get burned.
First thing is always, are you in a bull market or bear market? And then from there, once you have that decision and we decide bear market, then you just have to assume that all surprises will be to the downside. All right, just like in a bull market, surprises to the upside. Right. So this is just the flip side. And so what that means is whatever made you money the last 10 years, whatever made you rich the last 10 years, is probably not going to be the same vehicles that accumulate your wealth in the future. So the generals, to your question, Justin, is like you said, Apple, Amazon. There's a handful of the mainly technology stocks that when you look, they're in every mutual fund. They're in every ESG fund. They're in every this fund. They're everywhere. They're overly owned, and so when those start to get sold off in portfolios, the Apples and the Googles and the Amazons, then you know that we're getting close to the end, and that hasn't happened yet.
I brought it up earlier that I found a video of you talking about the 2009, market cycle, and you brought up a
video
stat.
That old, oh boy.
You brought up a stat back then, as we were going through the 2009 cycle, that there's less stocks than there are mutual funds.
Yeah.
That hasn't changed from today. There are more mutual funds and more ETFs than there are stocks.
Sure.
Yeah. So you look at all the mutual funds that are out there, all the ETFs, like you said, they have all those 10 stocks weighted in them. So that's where when the selling starts to happen and all these ETFs and all these mutual funds start to sell those, just a snowball effect that's going to transpire, and really your portfolio is not diversified. The 60-40 that they talk about, you're not spread out in anything. You're in all those 10 stocks that are majority of those.
This is when people learn that why do I need 15 mutual funds
Right.
that I'll own the same stocks? That this is why 5 asset classes matters, because you focus on reducing correlation.
Right.
Everybody else in the business is diversify. Well, what the hell good is that if all of them are going down?
Right.
Like if the tide's going lower, I don't want to be in a boat. I want to be in a plane. Right. So it's like ridiculous to me the way the business works, but it is what it is. That's why we do what we do. But here's the thing. We don't want to scare people away from investing, because the reality is the best opportunities are right in front of us.
Right.
In fact, there's even some good opportunities in the current market for people that have the right kinds of time frames and the right kinds of attitudes. So, there's still areas of the market that have great relative strength relative to other things, right?
Right.
And that's what you search for. Anytime you're looking for an opportunity is what's stronger. So there's things there, and the greatest opportunities are right in front of us. So the last thing you do right now as an investor is run away and hide. And the best way not to run away and hide is don't take on great big losses, right? You create cash.
Yep.
So when the time's right, sometimes you're going to lose money. You can't help it, right? You just know you're going to lose money, but in that pace, then recover as quickly as possible. Don't cry about losing money. Don't sit there, I lost money. Focus on what you're going to do next. Pick yourself up and get to the friggin' finish line faster. Don't be a baby. So, strategy and tactics really matters in a bear market, and knowing your alternatives is the key. And one of that strategies and tactics is don't get emotional in these things. And how you don't get emotional is don't take on big losses.
Yep.
All right.
What are some of the What are some of the strongest and weakest investment ideas?
Okay.
I like this. Think stagflation.
Yeah, I think if you're an investor out there, so I always think of these things in a couple ways. Is people listening to these things are either sitting in cash, wondering what to do with their cash, how to get in. They're already invested. They're already in the market, and they're wondering, hey, what do I do? How do I preserve myself? How do I make my portfolio grow more or preserve myself, whatever it may be? And then you have people that have long-term gains that are so big that in their thought process is, well, if the market goes down, I give back some of my gains. But if I sell, I got to give money back to Uncle Sam. So what's better? Giving 20, 30% back to the market or giving 20, 30% to Uncle Sam? So some people have those dilemmas. So I always think about these things from that aspect. And so if, where would I be looking if I was one of those people? And I'd say start off with something that has stronger relative strength. So energy, as we talked about, we may be seeing the last bull market in energy. I mean, energy is an interesting place to talk.
I agree.
Plus, if you're in the red zone and a retired person, energy pays great dividends.
Mm-hmm.
Right. So if you're a income and growth seeker, all of a sudden now, possibly this sector becomes like it was when I came in the industry, where it was in a secular trend higher.
Well, and emphasizing that we haven't seen the last bull market. We're still in the early stages of the coming bull market of energy.
That's what I mean.
Yeah. I just wanted to clarify that people then, because we showed that energy has pulled back quite a bit from its highs. That this is just a pause for the next just huge expansion.
And we'll get into this in our next wave piece, because even environmental people are going to be upset with this, because they're like, oh yeah, but there's ESG, there's all this stuff. I'm telling you right now, the push towards ESG is also going to just increase more fossil fuels. Like people don't realize, everything you need from an electric car, right, is from the four corners of the earth. Like the furthest corners, it's Australia, Chile, it's like all the four corners of the earth is where you find cobalt and all these things. So that's where most of it comes from. And so all these people in the environmental world, like, oh, it's better for the earth. Really? Because you got to transport that stuff from the corner of the earth to the middle of the earth to get manufactured. You're using fossil fuels while you're doing that, right? Whereas fossil fuels are basically right in the center of the commerce world, right? So at the end of the day, even as we work towards more and I'm a big lover of the environment. You guys know that. I mean, I love I cried this morning because I read an article about a whale that's all entangled in stuff in Massachusetts, and I was like, oh my God, a whale, So I love the environment, but nonetheless, it's going to come. So we're going to talk a lot about that in the next wave. But another area of relative strength, utilities. Everybody has forgotten them. It's also a risk-off trade.
Yep.
Yeah.
Pays a good dividend.
Pay. Food commodities.
I think this is an important one too.
Going to be way more volatile.
Yeah.
But at the end of the day, population, we don't have enough food.
Still got to eat. Still got to drink. Still got to
buy
toilet paper.
The food and water are kind of play hand in hand. The drought aspect of it on food, the drought aspect on energy consumption and production is just a huge contender.
The opportunity in water is scary. And I say that because you can't do anything in the environment without water.
Right.
You can't even do biomass without water,
Yep.
right? You got to grow plants, right? You do fracking, you need steam. You do you mine for cobalt, you need water. Right?
Yep.
So if there's a drought, a global drought, right, and water usage drops, and people go, yeah, we got hydro. Yeah, but you know what? Hydro works off of dams. Dams are built for, number one, conserving water, and number two, producing energy. They're not there to produce energy first, right? So if water levels go low, they turn it off, right?
Yep.
And what are you going to turn on? You're going to turn on natural gas or coal. You know? So water's huge, and just because of where we are in the bear market, you can't ignore the dollar. And we're going to show you some charts on that. So the weaker areas, the things to probably stay away from, are going to be things like technology. So this is where we see the dark side of overconcentration of stupidity, right? That we talked about. Everybody's in the same stocks. So now you get to see the other side of that, just like we did in 2000. Basic materials looks horrible on a chart. A lot of that's housing related, because with the rise in interest rates, that looks weak. I'm surprised the home builders aren't weaker than they already are, but I look at the home builders and I think fundamentally and from an environment standpoint, it's the worst environment for them, right?
It's changing fast.
Yeah. Now, could they be a great buying opportunity in the future? Absolutely. But in the future, right? We got to get through this phase. And boy, have junk bonds led the move lower. That's a huge tell. I mean, when junk bonds are moving lower, that tells you the institutional guys are not feeling frisky at all. And so that's interesting. And I would expect small caps will start to lead. Once I see the junk bond or corporate bond, high yield bond space leading, I usually expect the small caps to go along with them. They've been a little stubborn, but I think you'll see that eventually.
Well, and I want to go back because we didn't really touch on the real estate sector with the stock market when we were talking about it a little bit ago, and you know, we did do a lengthy video, but like you said, we needed an update. But because we have the home builders listed here, you know, it's like 184% or something like that of their new development to sales, which has never happened in history. And it's kind of changed my thought process of what potentially the new real estate downturn could look like. And it's not going to happen overnight. I think a lot of people are saying this is going to happen quick. I don't feel it's going to happen as fast, but the home builder aspect of it, they're just going to dry up and they're going to stop building houses, and we're going to go back to like what they did in 2008, where we hit a period now of another slump of no new product coming on the line. People can't sell right now because they can't afford to move into anything. So our whole supply is just going to dry up to nothing. And that's why I feel that we're going to continue kind of having higher prices, because the supply is not there, the little buyers that we have, but it's going to cause an even more of a glut for the future, to where those home builders, I think, are, like you said, are going to be really advantageous to be able to buy, because we're going to be in a supply slump again, and they're just going to have to overbuild like they've been doing the last couple of years.
You bring up a great point, and there is a historical analog. If you look in the 70s, it was similar, right?
Yep.
And you would think that in the 70s, with all the rising interest rates, that real estate would have crashed. If you look at prices of real estate in the 70s, they didn't crash. They had moments of sale, and that's why, like, stagflation. If you're an investor and you're thinking, okay, what's the environment I'm in? It's not inflation, it's stagflation that you're in. So you want to look for the assets that do well in that, which are very, very few. So and as part of that, real estate gets into this really tricky area where, when you look at the averages across the nation, the numbers on the larger averages will mask bigger problems in local markets, right? So at different times. So I do believe that real estate becomes very regional here, where if you were in a region like Phoenix or Austin or Boise or somewhere where you had a lot of iBuyers and you had Redfin in there buying houses, and in the past Zillow and stuff, you have to remember, when corporations buy things, it's not like you and I that are buying a house and our family's moving in it and we want to live there, you know, for a generation. When corporations buy houses, it's all numbers. So if they're down 3, 4, 5%, they're going to cut, right? You saw that with Zillow. Redfin's having all kinds of problems. So because of that increase in corporate buying in real estate, I think you create now more volatility in real estate, but it becomes very regional volatility.
Right, sure.
We'll see how that, and so I do think where it's one of those things where you look at the general numbers of real estate and it's like, yeah, you were down 5%, but then you'll go into certain markets and they're down 30.
Right.
You know?
Well, and if the Fed has their way and they destroy the unemployment number, which is what they need to do to really get us through this, because they're not going to tackle inflation by just interest rates, because it's bigger than that. But if they truly destroy our unemployment number and unemployment skyrockets, unemployment, they're not going to be able to stop it, and unemployment is just going to go haywire, and that's what's going to kind of have the more of the rippling effect, I think, across the board for real estate than just
listen,
secular or regional.
If you
areas.
want to look at big trends, you guys are the problem. You and Justin are the problem.
Of course. I mean,
you
that
guys-
doesn't surprise me
Been
at
the
all.
problem since I showed up.
Your generation is the problem. It's large, right?
Yep.
Yeah.
The other big generation we have is aging and taking less risk and reducing down and spending less, right? And if you look at what happened in the U.S. and demographics and numbers, as the baby boomers were hitting 30s, there was inflation there because there's a demand for things, right?
Yep.
We're seeing the same thing. This is not, the history books have shown us this.
Yep. It repeats, just not in the same way.
We're just at tipping points that it's really in our face right now. So nothing to be scared of. It's actually kind of exciting to see and realize we're actually living in a time that in the world of economics and markets that is, watershed. Now most people are like, "What do you mean? I'm so scared." All right, let's move on.
All right, stock market, real estate, cash or crash or buy the dip. I keep screwing that one up.
You want to
in
cash
this,
in?
Well, yeah, because I think everybody should be in cash.
But I forget what we had next. What was it?
Yeah.
The signs to watch for. Retail, we'll move fast through this because we're running long. Retail needs to capitulate. Like we said, the generals need to get shot. Interest rates and the dollar need to weaken before we can get confident about equities. I do think, one of the first big signs will be all year the behavior between stocks and government bonds has been not the norm. Normally, when stock market is selling off, people run into treasury bonds because that's part of the risk-off trade. And so when the stock market's falling, typically interest rates go down as people are buying more bonds. This year, and that's why the old 60-40 mix always worked, 60% stocks, 40% bonds, because it kind of tended to offset it. 60-40 is a widowmaker this year because you lost on both sides. The stocks are down, treasuries are down because interest rates are up big. And so what ends up happening in that situation is the first sign is we need to see that when the stock market's selling off, treasuries are rallying. Yep. We need to see the old behavior come back where people on risk-off days are going into treasuries. We started to see that a little bit Thursday, Friday.
Yep.
Too early to tell if that's a new trend, but that's what we're going to look for, and it's not there yet.
Not until the Fed hits their targets of over 4%.
Yeah, I don't think it happens still. I think between now and the election, there's a lot of, I think between now and the election, they focus on at least getting interest rates to moderate and really trying to get oil and gas prices down because they want to get reelected.
Right.
Yeah.
So the first opportunities when we get through all this stuff will be just like we've probably seen before, which is it'll start in the fixed income markets with maybe mortgage-backed bonds, then corporate bonds, then equity. There'll be a rotation as the market bottoms. So if you take on losses throughout this process and you want to know how to recover quickly, which is, like I said before, don't be a baby about this, just find out how you recover, then there's a process that the way that markets bottom, there's a process to it where you can rotate and be strategic with your funds. So that way, as the market recovers, your portfolio will ebb and flow with that recovery.
Right.
Recover hopefully faster.
Yeah. Optimization.
Yep.
So, and this is the currencies. Let's get into this. I love this. I love the dollar.
All right. What is going on with the dollar? I think this is really good. A lot of people, I know at the beginning part of the year, a lot of people said that the dollar was dead, and you and I were talking, all three of us were talking that I think this is a time where the dollar is going to get strong and continue to get strong.
Sure.
And do you think we're too long in that tooth, or where are we in that?
Go to the charts.
So yeah, what to expect in the next phase of the bear market, and how to protect your portfolio, or how to protect and profit from it.
Well, so we get at least 3 calls a month from people.
And yeah, check out the date here.
Yeah, June 12th. So we get at least 3 calls a month from people going, I got this article, I read something that the dollar's gonna, go worthless, and the government can steal all my money from the bank, and should I buy bullets and Butterfingers and hunker down? And what's interesting is even though throughout all those Obama years, everybody was like, oh, the dollar's doomed, it's going lower, it's going lower. This is a chart going back to 2019 that we shared in June to show that really since the pandemic bottom, the dollar's had a lot of strength. I was thinking we had this little 5-wave rally that was coming into resistance. So last time in June, that's all right. Yeah. Last time in June, I thought the dollar was going to take a decent pullback, and we were wrong. And if you ever want to be wrong,
had the signs there.
Yeah, if you ever want to be wrong, this is the best way to be wrong, because where you're wrong is you're expecting an asset to decline. Yep. And if you go to the next slide, thank God we were wrong, because it, rather than declining off of that line of resistance, it just powered through it. I mean, it just boom, just right through the line. And so that changes my perspective.
Agreed.
Like I thought that was 5 waves, we take a breather. This makes me feel like the move in the dollar is bigger and more secular than I thought, which makes me feel that the recession could be a little bit globally bigger. I don't know how it'll be for the U.S., but I believe it'll be really globally much bigger than I originally than anybody's, I think, talking about. And I think that it makes the bear market in equities more treacherous and more like what we saw in 2008 from the aspect of we're getting into that second phase where the dollar sucks the life out of everything. And as investors, the portfolio mix becomes something that people aren't used to, which is a lot of cash. If you're able and handle the risk to short the market, and that's really more of a professional's game, but nonetheless, we'll bring it up. And it becomes like it is one of those weird times that maybe the world becomes own the dollar and nothing else, and move to Costa Rica and sell tacos for a year.
So I don't want to drag too long here because I know we're running a little bit long, but in the past you've mentioned, other nations, other people wanting to hoard dollars, and that helps drive the price of the dollar going up. Could you kind of elaborate just a little quick bit on that so people could get an understanding of what you mean?
Yeah, I think Patrick had shared that video. Did you share that with me? Or they talked about the dollar milkshake.
Dollar milkshake.
Yeah, I think it's a great video.
Right. Brings all the boys to the yard.
Yeah. My milkshake brings all the boys to the yard. Damn right. It's so there is a video out there called the dollar milkshake. I don't know. We probably should share it somewhere. Maybe we'll put it in the notes on the YouTube notes.
Yeah.
But it's a great explanation of basically what happens is if you think about all the trade in the world, oil, gas, everything is settled in dollars. Most debts are settled in dollars as well, cross-border transactions, things of that nature. So when there's a crisis in the world or there's a recession, the demand for dollars rises. If a economy, another country, especially the emerging markets, get affected the most, they need more dollars, but their economies are slower, so they don't have as much intake of revenue from taxes and stuff, so they have less dollars. They have less of their currency to turn into dollars, right? At a time that the demand for dollars is higher and prices are rising. So if you're an emerging markets type of government, you end up having to chase your exchange rate higher and higher and higher, and it really damages the rest of the world's economy. And that's why what you will hear as we go into this, you will hear about how the U.S. is the strong. Yes, we're in recession, but we're not as bad as Europe. We'll become the cleanest dirty shirt. We'll be the tallest midget in the room. And it was like, okay, great, but it's designed that way. It was designed that way after World War II, right? And that's what China, Russia, and Iran and Iraq would like to disconnect and are working towards over time.
And it's why you hear so many people saying the dollar is doomed, because they think that is it is bad, but it's not it's happened before in history. It's a normal thing, normal occurrence of what we can expect. It doesn't make the dollar doomed.
And it could be over 50 years.
Right.
But if you're 75 years old, do you care what happens 50 years from now?
Yeah.
Probably not. All right, you may care, but does it affect your pocketbook?
Yeah.
So, you want to focus your energy on investment thesis. Yeah, you want to focus your worries and energy on can I make money off of. So let's turn this into what you can do with it. Okay, go into interest.
We're going into interest rates.
Let's finish into interest rates and give everybody some actions.
Yeah, so interest rates, how much higher could they go? And what can an income investor do? What can they be doing now?
Yeah, this is real key.
I got some good questions around this.
Yeah, let's go to the charts, and then we'll wrap it up for everybody. So this is the chart we shared in June. We were basically at that moment, we have this channel. We've said for years, interest rates trade in channels. Then they'll break out of those channels when there's a major fundamental shift happening. And obviously there's a major fundamental shift happening in the world. So we broke out of that channel. Our attitude then was, we'll probably one of two things. We'll either slow down here and maybe snap back down into the twos if people got worried about recession. Or if that doesn't happen, you're going to 4%, just like as a round number target. And since June, yes, there's been a little, is there going to be? Yes, we have 2 GDP numbers negative, but it's not a real recession because employment's so good. So there's been this wishy-washiness on recession. So there's been no need to snap back. There was no pivot from the Fed. So no need. So now it's gravitating higher towards that round number of 4, right? So let's go to the next slide. Similar to the dollar, my attitude's changed here because if we would have kind of stalled at the red line and come back into the channel and played around in there, then I would have thought to myself, okay, interest rates are probably going to stay between 2 and 3% for the foreseeable future until we find out what's going on in the economy. Is it slowing down or not? But the fact that it's robustly broken out makes me feel like now, and you can start to go through some of this now, we're getting into a situation that the wave count and the move in the dollar in interest rates is bigger, just like in the dollar, because they're correlated, is bigger than maybe thought. And so now what it does, if you keep going, it'll give you kind of, I think what we're going to see here is a new range starting to get formed. Like we're in this last move higher in the dollar before it, kind of peters out and takes a breather. And then, but I think after that, the new range in interest rates is going to be like, between 3 and 4, and maybe 2.8 to 4.25, right? If that happens, that means mortgage rates, you should expect mortgage rates to be staying between let's say 5 and 6.5, right? If you can keep mortgage rates at 5 to 6.5 for like a year and a half, people will adjust to that. Prices will probably come down, but prices won't have to come down that much, right? Think about it. We're already there. And we already know that for every $100,000 you borrow, this kind of move equals X number of dollars each month, right? So prices will eventually adjust for that in the areas that affordability needs to adjust. So I think the trick for the Fed is just get stability here. If they can just get it between 3 and 5, stay stable. Right now, we just don't know where it's going to settle. So from an investment thesis, if you go to the next, go ahead.
Before we go on, because one of the things we talked about the other day was, our thought process has changed, and I more and more am starting to agree with you because the days of cheap money are gone. The days of low cost of employment is gone. The days of cheap inputs for production are gone. So there's no way that we can get low interest rates anymore because we have high inflation, we have high costs of goods, all this type of stuff that's going to be around for the foreseeable future. So the days of lower interest rates I don't think are going to happen as much. Typically, Fed has reversed and lowered their, Fed funds rate. I don't think they're going to be able to do that going forward.
I think they do it if there's defaults that are systemic, like always.
But I don't know
if there becomes a systemic issue, then you'll see them. But until that systemic issue arises, you're probably right. And you should never build your investment portfolio or your investment thesis around systemic. It'd be you should never build your investment thesis around things that happen once every 30 years. You build your investment thesis around what happens every 3 out of 5 days.
Right.
So let's what do we got next? And it's so yeah, I mean, if I was retired, or if I was somebody who was like saying, how do I, with interest rates rising, stock market falling, if I'm in cash, how do I create income? If I'm changing my portfolio around and I still need income, what do I do? Right. Well, then you go for those dividend-paying stocks that we identified in those relatively stronger categories. If we're right on some of these secular trends in energy and utilities and things like that, that's very helpful. And I do think that's part of the Fed's understanding of things, is that if you are going to take away from the baby boomers' net worth a little bit, at least make the income thing providers a little bit more palatable for them. So I would stick in those. I would be looking in those sectors, and this is only for somebody who's like, I got to be an equity holder, right? Mm-hmm. If you like, just this is the only way you do things. Just remember, we're in a generational bear market, so keep a lot of cash, and keep your mind on recovery, because I think even these particular sectors, relative strength means that they're stronger than the others, and that can mean that the worst sector goes down 30%, and the best of the worst downside is down 10. So that would be the one down 10 is relative strength better than the 30, but you're still down, right? So when you're in a market, when the tide's lowering, even the stronger relative strength sectors are working against the wind. So if you're going to be in equities, play small until we get through this bear market. In the fixed income world, patience will pay, because you really don't want to be making a lot of moves in the face of interest rates blasting higher. So you want to see a little bit of a reprieve and see where this new range becomes, and that's going to be 6-8 months before we really know it for sure. We're going to speculate and guess around it, but we won't know for sure until it's hindsight.
Well, one nice thing about the 2-year having a pretty decent yield is that at least you can hold and get a 4% and hold it for 2 years and don't have to worry about that volatility in the interest rates.
I thought I'd never hear people call me up and go, wow, man, I'm going to get 3%. I remember when rates dropped to 5 and people were like, I'm taking my money out of the bank. 5% is not enough. This was like, late 90s. And like now it gets to 3 and people are like, holy cow, 3, wow, well, give them all my money.
Right. I've seen a few bank savings accounts at 1.5–2% now.
Yeah, well, I mean, that's why they do it.
Yield,
yeah. Now, realize what happens there. This is how the banking system works, if you want some insight. So what's going to happen now is people who have their money in like a CD, that's in the banking system. And then what will happen is they'll log on and Chase will send them a little message of, hey, we have a high yielding money market account that is like a point higher than the CD. That actually creates more dollar strength, right? Because what ends up happening is when you move from being in a CD to that money market's backed by treasuries and other things. So now it's out of the banking system technically, right? So it's an interesting thing that feeds upon itself with and this is why they raise rates is it takes money out of the system, out of the banking system, and then when the bank has less money, they can't loan as much, right? Yep. But it's still more profitable for the bank because they're offering a product that has a bigger spread, right? So they make the money on the back end. It's an interesting business. So when the time's right, same thing. The pattern will be like we talked before: mortgage-backed bonds, corporate bonds, equities, boom, boom, boom. When the time is right,
this is important. Yeah.
Build a bond ladder. Yeah. Don't buy a bond fund. I mean, don't be lazy. And don't work with somebody who's lazy. If you sit down with a financial guy and you say, hey, I want fixed income, and they come back to you with 10 mutual funds that are bond funds, just leave. I mean, that's not.
Why are you paying them for
He
that?
didn't work, folks.
Exactly.
There was no work done there. I mean, okay, sure, he Googled, right? But if you want somebody to earn their money and actually work for you, build a bond ladder. Do it right. Cut out all the middleman. Build a nice bond ladder. Get the bonds at a discount. So then that way you get income and growth. And then that way at least you get what you paid for. and you're not victim to the broader, whims of the market. You can build a bond ladder very concentrated in ways to manage risk.
And for those that may not know what a bond ladder is, you're basically laddering out all of this. So if you choose a 10-year period, you're going to have a 1-year bond, a 2-year bond, a 5-year bond, 6, 7, 8 years, all the way up to 10 years. And each one's going to mature over a certain period of time, and then you kind of just continue to cycle that ladder.
That was a good explanation.
Yeah.
Oh, nice.
So
climb the ladder. So what else do we have there?
Know your alternatives. Here you go, Patrick.
Yeah.
Let's
I mean, hey, listen, if you're a fixed income person, this is where knowing alternatives are, and so we didn't want to like in this area, alternatives are pretty broad, right?
Yeah.
But it's Patrick, give him a couple alternatives maybe in the real estate space. Or
and
like
first I want to emphasize,
it's not for everybody,
but more so that there is real estate in the stock market. Vanguard has a mutual fund of real estate. This is not what we're talking about with alternatives and diversification. People on the talking heads are going to say how they like it because they like the underlying asset in there. The problem is because of the liquidity, because of the tradability of it, all ships sink during a recession time period. So when we talk about real estate, we're talking about things that are not correlated to the market. And the ones we really like for on the real estate side are self-storage, which has been proven year over year that is recession resilient. And during high inflation rates, they're able to raise rents, those type of things. Easy to change over.
Still a fragmented market even after a lot of consolidation.
Right. And people downsize. If they lose their unemployment, they don't want to sell all their stuff, so they put it in storage. During up times, people buy too much crap on Amazon and they don't, they put the old stuff in storage. So it's a very, recession resilient, growth resilient type of play. And one other one that I just want to mention that, we didn't really talk about was data centers, cell phone towers. These are things that everybody is going to still have a cell phone. If you lose your job, you're still going to have your cell phone. You're still going to be watching YouTube. You're still going to be watching Amazon, Facebook. These are very recession resilient type of asset classes that will only benefit you during a time of rising rates and inflation. Yeah,
and I would say just follow what rich people do, right? If you want to, go where the money goes. And in these, when you watch what wealthy people do in these situations, they go up the food chain. They look for security in their assets, right? Because if they can get security now, they can always turn that into speculation later. So if you're going to do something, then, and this would be in the alternative space, you become a lender, right? You secure that lending with some kind of asset. And if you're going to go into the real estate world in a bear market, then you got to break down real estate and say what sectors or what areas of real estate still have opportunity even if the overall economy slumps. So you can analyze the real estate alternatives just like you can sectors in the stock market. And then outside of that, you have things like we talked about with Jordan Kimmel, where you have long short funds and hedge funds. That may not necessarily be your big income producers, but they can be kind of hedges to portfolios. So that's another feature of alternatives, and a lot of those will have more liquidity. And a big thing for people. This is also why alternatives work well in a portfolio and in reducing volatility is because think about this: if you go into an investment of storage units or something like that, well, the value is not tracked day by day like a stock is, right? The value is valued, quarterly and annually, and so your price changes are pretty much irrelevant until the moment you sell. Right, so everything that happens in between doesn't freak you out because you're not seeing it on your Robinhood app and crap like that.
Well, and you talk, the lending aspect of it. You talked about how it's interesting how banks make money.
Sure.
Well, you can do that yourself. So it's like being your own bank is another great way of taking advantage of rising interest rates to benefit yourself and not have that volatility because you now own whatever underlying assets. I'm not just saying give money willy-nilly. It's you got to have an asset backing it, whatever equipment, whatever it may be.
Yeah. So there's a lot of alternatives out there, and not all of them are real estate. But there's at the end of the day, in this kind of environment, if you are going to take risks, then secure the risk and and not be in the masses. So what do we got next? I think that's
I think that's it.
yeah, I really want to make sure everybody visits the YouTube side. If you are in the red zone, I think our last video really nails it on giving great advice of what you should be doing now in this bear market. The moment we put it out there, it started getting high. I mean, we got the best feedback ever because so many people were like, you know what, I've been feeling a lot of anxiety. They've been like, wondering what the hell they're supposed to do next. And then, they're like, hey, can't you just make it simple for me? And it's like, yeah, we can. We can help. We can do all those things. We can help you reduce some anxiety and make things easy. But what you got to do, you got to accept our offer, right? You got to accept our offer to have a conversation. And as you can tell, we're pretty friendly people. And conversations don't make commitments. So just talk to us and we'll tell you what we're seeing and what's specifically right for your situation, because these are very customized decisions. Everybody's situation is different. You can't take what we talk about here and just plug it all into your aspects. So do not use it as investment advice. Use this as a reason to reach out to us.
Well, and keep in mind that your Edward Jones advisor, your Morgan Stanley advisor, your Fidelity advisor, they're those type of name brand advisors for a reason. They're going to push you their type of material, their investment choices, philosophy, which doesn't necessarily mean that's advantageous or right for you. That's what they have available to be offering you. So getting a second opinion that's not tied to one of those groups is just going to overall round out your portfolio and give you a different thought process of ways to tackle things.
No, the mind that got you into the problem is not the mind that's going to get you out of it. So let's wrap things up with that, folks. Thank you for joining us for Quiver Financial's Taming the 2022 Bear Market. Stay tuned for more to come and have a great weekend.